Harmohan Sahni, ED and CEO of the real estate business of Raymond, is joining in now from the conference. Mr. Sahni, thank you so much for your time and great to have you here with us on NDTV Profit. So the real estate division, I think a foray of the group which has a lot of focus and excitement. You've been in the news for the redevelopment that is taking place in the suburb of Mahim. Tell us what the progress on that is.
First of all, thank you very much for having me over. And you touched upon joint developments. Joint developments, of course, Bombay as a city requires a lot of development, and you know that there is a renewal which has been happening on the infrastructure side. So even on the residential side, it requires a renewal because it is an old city and a lot of places need redevelopment, and newer developments are coming up. So we are also participating in a big way in that. So we've got one project in Bandra which is already going on, and that redevelopment is going fine. The sales are really good. The progress of work has been ahead of schedule than what we had planned for. And the Mahim one is what we signed recently, and we are currently working on the plans and the approvals. So most likely in Q3 or Q4, depending on when the approvals are, because there is always, a little bit here and there wherever the government work is involved. There could be some, 20, 30, 40 days here and there. So either Q3 or Q4, we would see a launch of that project in terms of sales. So yes, things are going well. So far we've got 5 JDAs. We've got 2 in Bandra East. We've got 2 in Mahim. We've got 1 in Sion. So in all 5 JDAs, total gross development value is about 10,000 crores of all these projects put together. And almost 2 to 3 out of these should launch in the coming year itself, starting 1st April.
Why the focus, Mr. Sahni, why the focus on JDAs, joint development agreements? And yes, from a Mumbai perspective, it's a sitting duck, but it's a space also fraught with a lot of uncertainty. It has been tried and tested, and many have not really succeeded to that extent. So what is the thought behind pursuing joint development agreements as your real estate foray, or as the key proponent of your real estate foray?
So joint development actually in the sense is a no-brainer. I'm sure you already know, and the viewers also would know, that it's a more capital efficient model to follow. We are a capital starved country per se, and there are only 1 or 2 players who would be adequately capitalized, and they also run out of capital very quickly. And that's why you see most real estate companies every year or every 2 years or every 3 years would be raising capital, which is actually not liked by the investors, and it's definitely not a great thing to do. So how do you de-risk this business? How do you make it more capital efficient? It has been the perennial question, and one of the easy answers is do joint developments, especially in areas like Bombay where land values are very high. Landowners are very savvy, their expectations are very high. So closing a deal also becomes a challenge always because the value expectation between the buyer and seller doesn't match, so a deal doesn't take place. So joint developments become an easy way of closing deals also, because if the market rewards you, you can share that much more with the landowner. So it works for the landowner, it works for the developer in terms of capital efficiency. The interests are completely aligned between the landowner and the developer in that sense. Now you mentioned that it's not been a very successful model in the past. Yes and no. There are players who have successfully run this. I have personally been in the business for almost now 29-30 years, and mostly have done JDAs in my various roles that I have performed over the years with different organizations, and successfully so. In between, there was obviously a hiatus for about 10-12 years because there was not enough clarity as far as the regulation was concerned, especially in Maharashtra, in Bombay. But with the DCR 2034 coming in, and RERA coming in, GST being clarified, Even the premiums on the government side have now seen a stable regime for the last 4 or 5 years. So last 5 years or so, JDs are back in fashion because it's easier now to calculate and take a bet as far as the developer is concerned. So there is more stability and certainty.
Yes. So, Mr. Sahni, good morning. This is Hiral on this side. So I understand that good progress that's happening with regards to where GDV goes. Now, if you have to break it up between your own land parcel development versus the GDV part of it, JDA, I beg your pardon, how much of your revenues will come in from a JDA-led business model versus your own land, and what is the impact on the margin picture then?
So that's a very good question, and in fact that's a question we've tried to answer for the last 3 years, and every year we get a different answer. But currently where we are at is roughly about 30% of my pre-sales really comes from outside of Thana, and between 70 and 75% comes from Thana. In the coming year, outside of Thana share will grow naturally because with the launch of more projects, and we are accessing more micro markets, while Thana is the same micro market. So there is a limit to how much growth we can see in that one micro market. And the other micro markets we are not participating in, other than Bandra East is the only place where we've got one project where currently we have a project going. So once we start opening up, naturally the share of pre-sales from outside of Thana is bound to grow. And in the coming year, we are expecting it to be somewhere in the region of about 35 to 40% of our total sales. Pre-sales should come from outside of Thana. So, but the revenue proportion may vary because we follow a percentage completion method of accounting, and by the time the progress of project reaches a certain level, it is about 12 to 18 months that it takes. So yes,
Mr. Sahni,
the proportion of outside Thana will keep on growing, and the impact on margins, sorry.
Yes, so I understand the kind of revenue contribution you'll see, but very quickly, impact on margins. So is it the joint development that will lead you to margins of 25%, or is it your own land development that will lead you to margins of 25%, and by when?
So the guidance we have given is that our margins will flit between 20 and 25%, depending on which quarter we are in and which project sales are more, and whether there is a launch of a certain project in that quarter or not. So it will never be a static number. It will range between 20 and 25. So some quarters you may say 22%, some quarters you may see 23%, and that's been the past trend also. Going forward also, we will remain within this range. There has been an improvement in the margins. If you see in the last 2 to 3 years, we have moved from 16% margin to now 22-23% margin range. And that is where we will stay principally.
And with regards to pricing, what is the trend that you're seeing right now? Because your focus is going to be mid-sized as well as premium segment. The sales are happening in the premium segment, mid-sized overall. The word on the street is that it's slightly stagnant. Affordable housing is also slightly under pressure. So how do you see it for a Raymond?
So far we have not seen any pressure as far as sales are concerned. Depending on which quarter we are at, because it is partly seasonal, it is dependent on holidays and some of the other things, auspicious dates and festivities around that. I mean, barring that, we haven't seen any softness in the market or signs of tiredness. As far as price growth is concerned, price growth in Bombay has been very, very healthy and consistent. We have seen 4 to 6% growth in the markets that we are in. I can't say much about South Bombay, where the price growth was very steep, and now, probably that is one market which is probably showing signs of tiredness, but we are not present in that market.
Okay. And overall, if you see in terms of the realizations, bookings and collection, what is the growth expected to look like in terms of FY26, taking into consideration the kind of construction work that is going to be carried out?
So the guidance we have given so far is that you should expect a 20% growth from us, an upward of 20% margin, and an ROCE of 20% or upward of that. So all three, so it's a 20-20-20 strategy in terms of revenue growth, in terms of margins, as well as the return on capital employed. We hope that next year we will do better than that. I cannot give you a specific guidance because we don't have a policy of giving a number, but yeah, a general guidance is what I've given you.
All right. Thank you so much, Mr. Sahni, ED and CEO of Real Estate Business Raymond, speaking about what the outlook on the business is, and he's speaking to us exclusively from the Motilal Oswal Ideation Conference. So great to chat with you on that.